Hi, this is David with the Answer Trading System. Today I would like to address a common remark, and that would be that the markets are random and unpredictable. Of course, I don't think that they are unpredictable. As far as randomness goes, yes, there is randomness in the markets. Markets are a random phenomenon, are a natural phenomenon, and therefore there is going to be some level of randomness. And I should specify here that randomness is really just a matter of observation. What is random to an observer may not be random to another observer. It's really dependent on the level of knowledge of that observer has, and how that observer can somewhat to build cause and effect correlation between data, sequence of data, or where it may come from or not come from. So markets, they're a natural phenomenon because they're basically built by humans, which are natural, and or whether that's humans or perhaps algorithms built by humans. And the way they evolve, it's really the game of trading is that of at any given time finding the best possible price, whether one is trying to buy or sell an asset. And this is a progressive movement, meaning that those that are trading, they will settle for smaller and smaller concessions towards the ideal price that they may want. And this helps to build time series, an evolution of price that moves somewhat randomly, more erratically at higher frequencies, but it's more clearly defined at lower frequencies. And here I would like to mention Benoit Mandelbrot, which is a famous mathematician, especially if you're into computer graphics. He popularized fractals and that are being used for graphics applications. But more interestingly, in this case, in 1968, he came up with a paper that kind of evolved on the Brownian motion, or the concept of Brownian motion, and they introduced the concept of the fractional Brownian motion. I guess the main points of the paper are really that there is is theorized that signal a random walk can be established with as a series of interdependent movements. And also there was the introduction of the Hurst exponent, which is used to as a parameter to determine what is the, in brief, basically the volatility of a certain signal, and whether it's more or less trendy, or if it is trending in a positive or a negative way. And so this I guess this is a good basis on which one can build a structure and somewhat build a simulation and analyze the markets. So coming from computer graphics and games, of course, as I hear fractals, I think of fractal landscape or procedural generation of random phenomena like clouds or anything, pretty much vegetation. But there's one thing really to consider, the fact that random generation using procedural to generate procedural assets, it's really very much about building interpolation of known data. So in the case of when we're trying to build a terrain, here I have an example that it doesn't have randomness in it, but it may as well be added. But the whole point is really that there is a progressive refinement at higher and higher level of detail. At the higher level of detail, when we introduce a subdivision, whether it's regular or driven by randomness, we have a smaller and smaller amplitude. And if we were to somewhat reproduce possibly a known market from lower resolution to a higher resolution, we could build something that is somewhat believable using this technique. However, of course, this is not a prediction. This is only interpolation. It doesn't do any good to us if we're trying to guess where the market is going to be. So there are a couple of major applications that can still be used. And one would be to estimate the risk. So in this case here, I have an example that I take it from somewhere, one like many, that shows how one could build a simulation that can be used, for example, to estimate what's the risk, what's the to which degree of confidence a price is going to move either on the upside or on the downside, given a set of parameters. And these parameters would be, I guess in this case, would be initial price and then the volatility of the market. So I guess one could but introduce volatility in whatever terms, like a delta, or perhaps using the Hurst exponent. In any case, I guess this is a more realistic application of something that is fractal, meaning that something that is has a randomness and has a randomness at a different level of different resolutions. Another application would be that of estimating this h, the Hurst exponent, which I shown here in these examples. So the idea would be in a fractal landscape, one would select a certain h value to have, let's say, a terrain that is more or less rough. But we can do the opposite and take, for example, a terrain and then determine what's the value of h, and then this will tell us what is the roughness, what is the volatility, and if it is positively or negatively, this samples taken in a sequence, they're more positively or negatively correlated. This is something that I didn't really research too much in practice myself. I implemented something to reverse to determine the value of h. But again, as often happens, how many samples does one use, at which frequency makes the whole difference. And also there is a debate really on how this h can be determined. I guess there is not a concrete formula. It's really up to, in a sense, up to interpretation, as far as I understood, as far as I've seen from many different implementations that are out there. So guess this is as far as fractal and goes. So when I wanted to mention this because fractals are very interesting, and if you're in computer graphics, they're very intuitive, but they don't necessarily the ability to generate a fractal doesn't necessarily bring to the ability to use it to at a predictive level. And now, talking more in general about predictability, there are a couple of things that I would like to mention, a couple of, I guess, common mistakes, that probably beginner mistakes that I think are worth mentioning, because it's definitely things that I've stumbled on myself, and it would be better to avoid them. So I think in general, there are assuming that one has somewhat built this ability to predict market to some degree. First, if we do that at higher frequencies, let's say that we're hoping to predict what the next minute or the next 5 or 10 minutes of the market will be like. In this case, we have a basic issue, and that would be that we need to keep in mind that commission fees, they're going to be affecting very much the possible profit. And together with the commission fees also comes the slippage. So that means that if we were settling just for, let's say that we have the ability actually to predict the next minute of movement with a pretty high degree, the problem will be that within 1 minute, really the movement of the market is so small that probably just the commission fee from purchasing and then selling again the asset, there will be more than the profit itself that comes from the orders. And then with that comes also the slippage. So if slippage means that if we're performing market orders, we'll get the price that will be definitely not optimal, because we aim at buying at any given time at the perceived price level, but the price level will move depending on the volume that is in the market, depending on how much offer there is at a given price. And so the more we're trying to buy or sell, the more the larger quantity of this asset that we're trying to move, the worse will be the price that we get. So this is in the case of market orders, which are for which the price it's really automatically assigned by the exchange server. In the case of limit orders, one could set a price, and but then instead of getting perhaps an unfavorable price, simply the orders is not completely filled, if it is filled at all. So there is a slippage is still there. It just becomes more explicit in the sense that one has to build a system that somehow will chase the price, so that the order is the general order is going to be satisfied. So this is, and I mentioned this first because I think it's very common for one that jumps in the trading, especially algorithmic trading, right away. There is this idea that to make a lot of thousands of trades each day, and you know, the idea would be that in so doing there's a immediate feedback of what the ability of this algorithm would be, and also I guess immediate satisfaction from it. And so one could say then I will possibly move to a lower time frame. Let's say that there's this ability to predict at the daily level what would be the opening price and the closing price. And here there is a kind of I don't know if it is the opposite problem, but there is a different problem, and that would be that assuming that one has, yes, indeed, the ability to have a certain degree of prediction, of reliability of prediction, because the time frame is much larger, there is going to be a larger movement of price. And so if one day, let's say on the 9th of any given month, there is indeed the ability to buy and sell at a higher price by the end of the day. In between, there may be a lot of volatility, meaning that if there is a stop loss, the stop loss will be triggered, or otherwise one may have to one has predetermined that there is a certain level of volatility in this market, and therefore one has to settle for this level of volatility, meaning that there has to be a wider stop loss, and so the risk is higher, and there is going to be a less chance to use a higher leverage. So in a sense, it's conducive to less profit. And so I guess what's the solution? I mean, if a certain relatively high frequency of data may be not enough to build the profit with trades, and the one that is at a much lower frequency, there is maybe obstacles such as volatility, volatility at perhaps a daily, weekly, or monthly basis. The solution is really that one has to find the right somehow the right frequency at which it makes sense to operate, and this depends, of course, on the amount of data that one has, the ability to parse that data, the volume of the market, and the amount of the commission fees, and so there is many variables in between, and generally it may not be the frequency at which it makes more sense to operate in order to get profit may not be the ideal one, but it's important to understand where this prediction, where this ability to predict works, and how it is actually one is actually able to profit from it. And connected to that, there is another thing that I guess the last thing that I would like to mention, and that's let's say that one has built a pretty good indicator that is has pretty good prediction, whether it's a neural network or whatever. One thing that needs to be considered, and I think that's a common problem that I notice in published research, perhaps not very advanced research, but nevertheless stuff that has been published, And that's that predictability in itself needs to be considered in a larger context, because if, let's say, we have an indicator that is applied, it's applicable in order to predict the next movement, we need to first find out how far can it predict the movement. Is it going to predict in the order of minutes, order of days, or hours? And so if we apply only once this, let's say that we have a 70% confidence on this magic indicator, and this would be really already very high ability to predict. If we apply it once and it works in the order of minutes, then as I mentioned before, the movement is too small and there is really no benefit from it. And perhaps we can apply it in the larger term, in the order of days or hours. But as we go for a longer terms to predict, the prediction itself is going to be naturally is going to be harder to make because, of course, it's more into the future and is subject to more randomness. And so I guess the natural consequence from that, the natural idea would be that this predictive indicator is applied in a sequence. So let's say that if I can predict the next minute, then why don't I apply it for 10 times? I can predict the next 10 minutes. And so when I really find out that it's going down, then I will close my position or something to that degree. The problem here is that if we have a 70% degree of confidence, and again, this would be huge on our predictor, and we applied twice, so in a sequence, then we come down, we need to multiply those odds, and it comes down to already to less than 50% confidence. And this, of course, it gets worse and worse as we want to build, we hope to build a sequence of predictions. So I mentioned this because I myself initially made something of this degree, not as good, I think. Last I checked, it was maybe 60-65% degree of confidence. And as I was using as in a sequence, somehow the algorithm that was solely based on this, it wouldn't bring any meaningful profit. You can definitely tell that, yes, there is a predictive value, but why can't I make a profit from it? And the reason is this, that this degree of confidence needs to be considered in the context of a larger sequence. And again, even if it is just a sequence of two, we already have a subpar degree of confidence. So I guess, yes, that's it for me. I hope this went well. I wanted to do this video for a while. I tried several times, but hopefully this is it. Let's see if I'm satisfied with it. And yeah, if you have any comments or questions, please let me know. Otherwise, have fun. See you.